I mean, a lot has happened since that rate hike happened about a month ago. The overall global markets are in a turmoil. We're seeing a slowdown threat from China. Oil prices are also, sort of being they are extremely volatile. So in such a situation, what do you think that she can do tonight?
Well, the Federal Reserve is not going to do a heck of a lot. This is not a policy meeting where they're having a follow-up press conference, even though you could argue they should have follow-up press conferences of all the meetings this year. So they're going to make relatively small changes to the statement. They're not going to overreact to market events. To think that the Fed's 25 basis point rate hike caused all the problems of the last month is really a relatively far-fetched, but it certainly, as the Fed begins to drain the swamp, it makes these kinds of problems more evident. So the Fed's going to make small tinkering changes to the language. Perhaps they'll be less confident about a pickup in inflation, but the numbers are holding in reasonably well outside of manufacturing, and the last thing on earth the Fed wants to do is give any signs that they are having significant second thoughts or panicking. They've said, if the markets have difficulties, we will reassess. That is precisely what they're doing today. They're not changing rates. They're unlikely to do it in March, but to think that there'll be no rate hikes for the remainder of the year is also a stretch at the moment, given the current state of play of events.
But then, like it's about a month since the U.S. actually reversed its stance in monetary policy. Since then, what do you think has been, the big implications of the U.S. interest rate hike of 25 basis points? Because, of course, leading up to it, there was a lot of concern that, that God knows what's going to happen. But at least, there was a sense that the markets had largely factored that in. But, a month since then, I mean, what do you see are the visible implications of that U.S. Fed hike?
Well, the visible implications beyond the turmoil in the market is that will darken expectations of households and firms here in the States and bring about a self-fulfilling prophecy. We all have to recognize ourselves that markets are more volatile than the economy, but it is clear that the market is telling us something. If it is followed up by a significant swing in consumer confidence, then you have a serious problem on your hands. So far, that hasn't happened, and the Fed really does not want to overreact to markets that have fallen very sharply, but if not accompanied by weakness on Main Street, just tell us that a lot's going on in the marketplace beyond a major deterioration in the U.S. market. Last thing I'll say is we've got to remind ourselves that the U.S. economy is relatively insulated from a strict export flow. It's a relatively closed economy. Only 15% of our output is actually exported, and only 1% to China and 6% to Asia. It's where the subprime interactions could kill you, and that's what's so hard to divine. And the Fed's going to take a very long, hard look at trying to figure out how much of energy debt and how much of Chinese and Asian-related debt is really creating problems in the plumbing of the global financial system.
Cary, as our CNBC colleague, Steve Leisman was basically mentioning that on one hand, she cannot be seen as reacting on a frequent basis to how the markets are doing, but at the same time, she cannot be impervious to what's happening in the global market. So in that sense, how do you see her doing that tightrope walk?
Well, it's very hard to do it in the construct of a one-page statement where at most they're going to fiddle with 2 or 3 sentences and perhaps insert a new one. That's the difficulty of the policy statement. It's not long enough and it's not short enough. In some sense, it would be better if the statement only had 2 sentences. We met, we decided, we went to lunch. Or you got to have 4 or 5 pages laying things out. They're caught in a trap, but they just do not have enough time to make a valid explanation of what's going on, or a thorough one, in a page or less.
Well-known hedge fund manager, in fact, speaking to us sometime back, Ray Dalio, he basically said that I think that there is a strong case for U.S. Federal Reserve to actually reverse its course and once again resort to quantitative easing. I mean, how do you view that statement that Ray has made?
Well, I'd be very surprised that that would happen anytime soon. A year ago, similar individuals were chiding the Fed for continuing the quantitative easing that we had. At some point in time, U.S. monetary policy needs to be more normal. The U.S. economy has grown at 2.5% for the last 3 years. Underlying core inflation is at 2%. The economy is a lot more like a normal U.S. economy than policy is, and that's what the Fed's trying to renormalize about.
Right. Final question then, Cary. In 2016, according to a CNBC survey, there is an expectation that the Fed is going to hike rate at least 3 to 4 times. In the context of what has happened in the last 1 month, in the context of the fact that there is a slowdown in China, do you see the U.S. Federal Reserve actually staying that course and actually going ahead and making those interest rates hikes in the coming few months?
Even before the market went in its nosedive in the last month, the typical bond market participant was looking for 2 rate hikes this year. Even that looks like a stretch now. I think 2 is certainly possible. 1 may be more likely. They may be one and done this year, but you would really need the pins to be knocked out of the U.S. economy by the June meeting for the Fed not to probably hike at least one more time.
Thank you very much, Cary, for joining us here on The Big Picture. So we really have to wait and watch. There are a little over 2 hours left to go to actually see what the press statement she issues and the rationale she gives for whatever she finally decides to do.